What's up, traders? So today I'm going to show you the two different option strategies that most people with seven-figure accounts use. And not only that, I'll show you the data points that I look at prior to entering into any trade. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market, and I use the money I make from the stock market in order to pay for my entire lifestyle. Now, I'm sure there'll be several people watching this video who are new to options trading, and there may be even some that are new to the stock market in general. You are on the right path. The stock market is by far the best wealth builder that ever existed. It is the game that all the rich and wealthy play, and now it is your turn to play the game as well. And the beautiful thing about the stock market is it doesn't care about your race, your ethnicity, your weight, your gender, your political views, what you like and don't like, what type of mood you're in. None of that matters. It's just whether you're playing the game or you're not. So I'm happy that you're here. Just had to give you those words of encouragement, and may God bless you exceedingly and abundantly beyond all you could ever ask for. Now, before we get started, I want to ask that you hit the like button and subscribe to the channel. That would help me out tremendously. And do remember that I am not a financial advisor, and this is not financial advice. All trading comes with risk. I'm just showing you how I've built wealth over time. All right, so as mentioned before, most people with multiple seven-figure accounts use mainly two different option strategies. And if they use other strategies, it's usually a variation of one of these strategies. Okay, so let's get started. The first strategy is buying leaps. Now, if you're new to options trading, this video is going to be jam-packed, so stay tuned. However, if you're already very experienced, make sure you stay to the end because I'll show you a better way to go about things. All right, but our first strategy is buying leaps. Now, when you're buying leaps or long calls, the objective is to profit from a rise in the stock price. It is very similar to owning stock. And in fact, that's the whole point of owning a leap, is because you get the power of owning 100 shares at usually like a quarter of the price. So say you were wanting to buy a leap on Nvidia at the $100 stock price. Well, remember, every contract is worth 100 shares, and you were to buy 100 shares, that would cost you $10,000. However, if you were to buy a leap at the $100 strike price, you would probably pay around $2,500 for it. And so that's why buying leaps are so powerful, is because of the leverage that buying the leap gives you. And so here's a quick little example. So let's say we have a stock that is currently trading for around $50. What we could do is buy a $50 call, and a leap is just a call that goes out a year or more. All right, so we bought a $50 call, and for doing so, we paid $1,000. And from here, we're just looking for the stock price to rise, just like if we own the shares. But you can see in this scenario, we only paid $1,000 for this call. However, if we were to buy the shares of this company at $50 and we bought 100 shares, it would cost us $5,000. And that is the power of a leap option. All right, so what are the benefits of long calls and leaps? First off, you have a high profit potential. A rising stock price can significantly boost your options value. So if you buy a call, the higher that the stock price goes, the more and more that contract will be worth. And then the second benefit is the limited risk. The amount that you paid for the options contract is the most that you can lose. So in the previous example that we just used, that $1,000 that we paid to buy the contract was the most that we could lose in that situation. However, if we were to have bought 100 shares at $50, then $5,000 would be the max that we could lose. So you're essentially limiting your downside. But what are the risks of calls and leaps? Well, options lose value over time if the stock price doesn't move favorably. So unlike shares, which you can own forever, every options contract has a set duration. You can select contracts for 7 days out from now. You can select contracts for 7 months out from now. However, with a leap, it is always 365 days or more out. And I personally typically always select the longest duration, which is usually anywhere between 2 to 3 years out. But more on that later in the video. And now the second option strategy that most people with multiple seven-figure accounts use is called the will strategy. However, the first step in the will strategy is to sell puts. So that is what we are going to focus on right now. Now, the objective of selling puts is to, one, generate income and or to buy a stock at a cheaper price than what it's trading for today. All right, so unlike when we were buying leaps and buying calls, with selling puts, we receive money. So we effectively get to generate income and or you get to buy a stock at a cheaper price than what it's trading for today. And selling puts is very much just like selling insurance, but for stocks. So in the previous example, we had a stock that was trading at $50. What I could do is I could come in and sell a put at, let's say, $45. And for doing so, I am agreeing to buy the shares of this stock if it were to drop below $45. But for doing so, I get paid a premium up front, just like you pay your car insurance company a premium every single month. And so let's say I got paid $200 for this, and the contract is for about 30 days out. And from here, two things can happen. If the stock stays above the $45 strike, so if it goes up, I just keep my money. If it stays the same, I keep my money. If it goes down some, I still just keep the $200 I was paid. But as long as it stays above that $45 mark that we set, by the end of the contract, I just keep the $200 I was paid and I go about my day, and I could do the strategy over and over and over again. All right, so that is scenario number one. However, scenario number two is if the stock were to drop below the $45 mark, well, now I have agreed to buy 100 shares of the company per contract at the price that I set, which was $45. However, in this case, I still keep that $200 I was paid, just like your car insurance company keeps the money that you pay them every single month, whether you get into a car accident or you don't. Okay, so selling puts is just like selling insurance, but for stocks. And here's an example of that. So let's say Apple is currently trading for about $220. What I could do is I could sell a put at $200 for a contract expiring in about 30 days. And for doing so, I would receive $150. So this is me over here as the put seller. I'm telling the put buyer that, hey, I will insure your stocks. I will buy them from you if Apple were to drop below $200 by the end of this contract. All right, and we can see over here that here's Apple's current price, so $220. So if it goes up, I just keep the $150 that I made. If it stays the same, I just keep the $150. And even if it goes down some, I just keep the $150 and go about my day. However, if it drops below the $200 strike, then I will need to buy the shares just like I agreed upon. And so what are the benefits of selling puts? Well, it's the income and possible stock acquisition. So selling puts generates premium income and may allow stock purchase at a discount if the price drops below the strike. And so the best way to effectively sell puts is to sell puts on a stock that you would like to own at a cheaper price anyway. That way, mentally, it really doesn't matter what happens to the stock price to you because you're one, fine with generating income just to wait around, and or you're fine with buying the shares of that company at a cheaper price. So it's always best to use this strategy on good companies that you would like to own anyway. Now, what are the risks of selling puts? Well, a price drop may force stock purchase above the market value, while a price rise can mean missed gains. And here's what that means. So in the previous example, we used Apple, and we sold a put at $200 while Apple stock price is currently $220. Well, let's say something crazy happens and Apple stock price drops down to $195. Well, we have already agreed to buy the shares of the company at $200. So although it's currently trading at $195, we're still purchasing it at $200. All right, so that is partly a risk there. However, if you like Apple at $200 and you do believe in the company long term, then that doesn't really matter anyway. And then secondly, with option selling strategies, the income that you receive is the maximum amount that you can make. So that $150 that we made from selling that put is the maximum amount of money that you can make. Even if Apple were to go up to $1,000, you wouldn't make any more than that $150. All right, so when selling puts, you have a high probability of profit, but you'll typically make a little less. And then with leaps, you have a lower probability of profit. However, in good situations, you can make a lot more money than selling puts. Now let's take a look at a stock that I like to use for selling puts and one that I like to use for buying leaps. So when it comes to buying leaps, I like to use ticker symbol SPY. Now SPY is just an ETF that follows the entire S&P 500. So you have the 500 largest US companies all within the single ETF. And so when you're buying or trading this ETF, you're essentially betting on the US economy. And with times like this, I like to use S&P 500 ETFs because after downturns, we don't know if single stocks will recover. However, you can always bet on the US economy improving over long periods of time. Now for leaps, one of the first things that I look at is the stochastic. So the stochastic is down here, and the stochastic just aims to show you the direction that momentum is taking a stock. And so if it's pointing upwards, that means buyers have momentum. And if it's pointing downwards, that means sellers have momentum. So you can see during this month-long period where the stock market was going down, the stochastic went down the entire time and pretty much stayed in the oversold area until here recently where the stock market started to rebound a little bit. So that is the first thing. I want the stochastic pointing upwards. And then another thing is this blue line here is the 200-day moving average. And typically it's a huge point of either support or resistance. And we can see just a few days ago, it did come up and actually close above the 200-day moving average, but then it bounced right back down. And so what I want to see is a few days of it closing above the 200-day moving average, in which next week, April 2nd, will be a big day because that's when more tariffs are set to go into effect. And so by then, we should have more clarification about tariffs because this big downtrend right here was all because of headlines about tariffs. And things were seemingly changing every single day and we had no clarification. So tariffs are what caused this downtrend. And I do believe that once we get clarification of how this is going to go and there's not going to be changes every single day, that will be when the stock market starts to rise again because our economy is actually doing very, very well. And so those are the only data points that I look at on the chart. However, we'll look at more data points once we open up our brokerage with Thinkorswim. But real quick, do you know anybody that can benefit from learning from me? Feel free to tell them about the Trade to Freedom community. Not only will they get my exact trades as soon as I enter them, but they'll also get my entire options course, which teaches about options from A to Z, and my specific framework on how I trade options. Thirdly, they'll have full access to me to ask me questions at any given time. And lastly, they'll be within a community of other traders that all have the exact same goals as them. So if you do know anybody that's looking to generate extra income off of the cash that they already have, then feel free to tell them about the Trader Freedom community. The link is in the description below. But let's get back to the video. Now, a stock that I really like to use for selling puts is ticker symbol UPRO. And UPRO is a leveraged ETF that follows the S&P 500. Now, if you're not familiar with leveraged ETFs, they are simply ETFs that look to move multiples of what the stock or sector that they follow move every single day. So you can see here that UPRO is a 3x leveraged ETF to the S&P 500. And so that means it looks to move 3 times what the S&P 500 moves every single day. And so if the S&P 500 were to move up 1% for the day, UPRO would look to move up 3% for the day. And the same works in reverse. If the S&P 500 were to move down 1% for the day, then UPRO would look to move down 3% for the day. Now, the reason I like selling puts on this instead of ticker symbol SPY is one, leveraged ETFs, because they move more and are more volatile, the option contracts have more premium. So that is more money that I am collecting up front. So that is reason number one. And reason number two is leveraged ETFs typically are at a lower stock price than the stock or sector that they follow. And you can see here that UPRO is currently $78, while if we go back to SPY, SPY is currently $570. So that makes selling puts on them a lot easier, because 100 shares of SPY would be $57,000, whereas 100 shares of UPRO would be $7,800. So that is quite the difference. Now, when it comes to selling puts, I like to take a look at the Bollinger Band. Now, the Bollinger Band are these black lines up here, but they just aim to show you the price range that a stock is expected to trade within. All right, and so most of the time, it's about 95% accurate. So you can see even going back, this is a 6-month chart. So going back to 6 months, you can see it trades within and then it pops out for a few days and it comes right back in. It'll pop out, come back in, pop out, come back in. But most of the time it trades within the range. And so when I'm selling puts, I like to look at the bottom of the range. So we can see that UPRO's range at the bottom is currently $72.46. So if I'm selling puts, I probably will select a strike that is below that mark. And that gives me a higher chance of just making my money and going about my day. But let's head on over to Thinkorswim, look at a few more data points, and look at a potential trade. So here we are in Thinkorswim, and I have UPRO pulled up. And now we're down here at the option chain. Now, first off, we need to select an expiration date. And for expiration dates, I always go within 45 days when I am selling puts. Now, that doesn't mean you need to select 45 days. It can be 35, 25, 10. It can even be 7 days if you like. All right, within the community, we have income generating strategies that are anywhere from day trading, which we use 0 DTE trades, all the way up to 45 days out for people who are a little bit more busy. All right, but let's say we're interested in some monthly income. So we'll go about 30 days out. All right, so let's see, we have an expiration date here that is 29 days out. So I'll go ahead and select that. Then I'll go ahead and scroll down a little bit, and the put side is always over here on the right. And now the second data point that I want to look at is the expected move. And if you come up here to the right, you can see this plus or minus number here, but you'll see it says plus or minus $9.03 currently. So that is the largest move that the options market is currently pricing in for UPRO by this expiration date. So since I'm selling a put, I would simply take that $9 and subtract it from the price that UPRO is currently. And that'll put us right around the $70 mark. Now, if we recall from the Bollinger Bands, it said that it would stay above $72. However, the expected move has us at $70. And so I typically always go with whatever data point is the most conservative. And then lastly, I look at the delta. Now, delta is this column here. And by definition, delta shows you how much an options contract will move per a $1 move in the underlying stock's price. So at this 0.20 delta, it is saying that these contract prices right here will move about 20 cents for every $1 move in UPRO. However, most successful traders that I know use the delta as a probability of an event occurring. So at this 0.20 delta, this $70 strike price, to me, that's saying there's about a 20% chance that UPRO, which is currently at $78, drops down to $70 by this expiration date. Or in other words, I have about an 80% probability of profit. And for me personally, I always stick to deltas of 0.20 or lower. Now, when I had a smaller account, I would go up to a delta of 0.30 because typically people with smaller accounts have to take on a little bit more risk. But now that my account is much larger, I do 0.20 and lower. And how ironic that the 0.20 delta and our expected move both landed at the exact same strike. So the $70 strike sounds good to me. Now we can see the bid and ask prices here, and we can see it's between $1.40 and $1.60. Now, every contract is worth 100 shares, so whatever you see there, if you are selling puts, then you would receive 100 times that amount. So we would receive anywhere between $140 and $160 right here, right now for selling a put. And normally you get somewhere between the bid and ask price. So let's assume we can get about $1.50 for this. So if I want to go ahead and open the trade, I can go ahead and select the bid price. And then it automatically brings my ticket up for me. And then we can go ahead and move it up to that $1.50 that we wanted. And if you like the trade, you can go ahead and hit review and submit the order. Now, another little tip is to do this on red days because you'll always receive more money. Yesterday was a big red day, so had I done this yesterday, I probably would receive like $200 or more for selling this exact same put. But today is a green day, so that price went down a little bit. But let's scroll down and look at the profit and loss chart. But if you keep an eye on that number there at the top left, you can see that here we are right here. This red line is where UPRO's stock price is currently. And so if the stock price goes up, we just make our $150 per contract. If it stays around the same, we keep that $150 per contract. Even if it goes down some, we can just keep that $150 per contract. But once the stock price starts to go below the $70 mark, you can see it starts to become a losing trade. And from here, if it stays under $70, you will have to purchase UPRO at $70, no matter what the stock price is if it is below it. However, because this is an ETF that follows the entire S&P 500, I am totally happy with buying the shares at this cheaper price. So that is selling a put on UPRO. Now let's take a look at buying a leap on SPY. All right, so here we are at the options chain for SPY. We have SPY pulled up. Now, leaps is a long call that is 365 days out or longer. However, I like to go to the furthest day out possible because it gives me the highest probability of profit. So I will scroll down here and it looks like the latest date they have is December 17th of 2027, which is 995 days out from now. So just a little bit short of 3 years. So I'll go ahead and select it. Scroll down, and now remember the call side is always on the left side. So now I want to look at the delta again. Now when it comes to buying strategies, to get the highest probability of profit, you want to buy a contract that is in the money already. So we're looking at these contracts that are up here, and I like to go to a delta of about 0.70. And the 0.70 delta will have us at a strike of $520. And since we are buying a call, we will be paying the prices that we see here. So it looks like the bid and ask spread is anywhere between $119.33 and the ask is $123.58. And so we'll be paying anywhere between $11,900 to about $12,300 per contract. And so that may sound like a whole lot. However, it's way cheaper than buying 100 shares of SPY, which you would currently pay about $56,900 for. So you're literally paying about 1/5 of the price. Now, if you have a smaller account, one way that you could utilize the exact same strategy, one, you could buy a lower delta. So you can see the lower the delta we go, the cheaper it gets. And also you can select a closer expiration date. All right, so I selected the one that is 3 years out from now. However, maybe you select the one that's 2 years out from now or a year and a half out from now in order to get the cheaper price. Now that does indeed lower your probability of profit, but if the stock market does go up in that time period, then you'll be able to make money as well at a much cheaper price. All right, but one thing you do not want to do is go way out of the money out here and buy a contract, let's say out here at $650 at a delta of 0.45, because out here, one, you need the stock price to rise pretty significantly in order to make money. And then two, the closer we get to expiration date, the time decay is going to eat the value of your contracts up. If the stock price has not risen above your strike price, do yourself a favor and don't buy down here. You're essentially buying a lottery ticket. I mean, your chances are a little better than the lottery, but you get what I'm saying. But let's go back up here. We said we were going at the delta of 0.70, which is the $520 strike. So I'll go ahead and select this here and it loads up the ticket for me. We are buying, and then we can select our amount of contracts. For the purposes of this video, we'll just keep it to 1. And you can see everything else is loaded. Now, same thing, we can select the mid price. So mid price will put us at about $12,100. And if we like that trade, we can go ahead and hit review and place the trade. But now let's go down and look at the profit and loss chart for this trade. All right, so same thing here. I want you to take a look at that number that's at the top left. And we know that this is a bullish trade. And so that number there at the bottom is how much the contract will be worth on expiration date 3 years out from now. And the amount with the blue dots is how much the contract will be worth today. Because as we get closer to expiration, there's not going to be much time value left. However, during the next few years, there's going to be a ton of time value. So you can see the difference between those two numbers there. All right, but as the stock price rises, you can see how the values are increasing and continuously going up. But the more and more that it goes up, the more and more money that we make. All right. But you can see how this could be a pretty profitable trade if the stock market goes up. But if the stock market were to go down, we can see the other way as well. Now, of course, this is a bullish trade, so we want the stock price to go up. However, the most you could lose on this trade is the amount that you paid for the trade to begin with. All right, so that $12,132 is the most that you could lose with this strategy. Now, with that being said, you would typically get out of this trade way before your contract value went down to zero. But as this is a 3-year play, we have plenty of time to watch this unfold. But ladies and gentlemen, as I said before, if you know anybody that you think could benefit from learning from me, tell them to join the Trade to Freedom community. It's great for employees, professionals, business owners, and retirees who all have some cash and they're looking to generate income off the cash that they already have. So tell them about the Trade to Freedom community. The link is in the description below, but make sure that you like the video, subscribe to the channel, and I will see you guys on the next one. Peace!